Okay, so this is going to be part one of my options explained video. If you guys like it, leave comments, add questions. I'll come out with a part two or a part three if people still want to watch it and they feel like it's informative enough. I like to look at options plays more as bets than investments because there's a lot more risk involved, but you can also, amplify your gains. Um, First off, before we even get into it, I just want to say I'm not a financial advisor. This isn't financial advice. I'm just sharing some information that I have, that I read about, or that I got through experience with you in case you want to get into options. All right. So, the purpose of this video is really to give you enough information to feel comfortable buying a call. And then making the decision about when you want to sell it or when you want to exercise it, which we'll get into in a little bit. If you need more in-depth information, I mean, there's a ton of good books out there. I've read a few. And then there's way longer videos than this one that I'm about to make on YouTube that really cover everything. So if you're interested in kind of seeing everything about options, and getting really in-depth, which I would recommend if this is something that you end up trying and you like and it works for you and you want to learn a little bit more, really go, if you're into reading, there's some great books out there, or watch some of these longer YouTube videos that really get into depth. Okay, of all the books that I've read, and I'll put a link down in the description, but it's called the Options Playbook. Is probably it's the smallest book. Some of the other ones were huge and really got into depth about Greeks and everything else, but this Options Playbook was the simplest. It was the easiest to read. It's the easiest to go back and reference. It's kind of like an options for dummies, like just gives you, in the simplest form, the easiest way to understand. So I'll put a link to that book because I really do recommend it. It wasn't too expensive. So as we get started, the first thing, what is an options contract? And if you already know what an options contract is and everything, I'm going to put some timestamps down in the description so that you can jump to different areas. But for someone who's completely new and doesn't really even understand this part of it, an options contract is basically a coupon to buy 100 shares at a later date. Okay, so I don't want to buy 100 shares today, but later on down the road, I might want to buy those 100 shares. So I'll go buy this coupon that allows me to buy it at a specific price later. Okay, so for an example, and this would just be, obviously hypothetical, but let's just say, so Disney right now, DIS, is trading at $185. Okay, so if I wanted, at 185 bucks, 100 shares would cost me what, 18,500. Let's say I don't have that much money today, or I have the money, but I don't want to tie up all my capital today in $18,500 worth of Disney, but I really want this Disney stock. Okay, I want to own this for the rest of my life, and I really feel like Disney's going to move to $250 by the end of the year. Okay, so what I could do is I can go buy an options contract on Disney, let's say for the January expiration date, right? Which means when January comes around, if I bought, let's say, the $185 strike of Disney, when January comes around, I could now, give my coupon and buy Disney for 185 bucks. Now, if Disney's trading for, $250, $300 at that time, well, yeah, I mean, a great trade. Yeah, who wouldn't want to buy it for $185? A share. That'd be awesome. Now, on the flip side, if Disney's trading at, let's say 150, 120 come January, then I don't have to use my coupon. I could just let it go. And that's why options is also a gamble, because if you don't hit that price, that target price, you just lose the money, right? So anyway, so we have this coupon that allows you the opportunity to buy a stock at a certain price. But with that, the coupon has a cost. It has what's called a premium, right? So right now, Disney, if I wanted to buy that $185 coupon for Disney for January, the premium on it right now is 17 bucks, which is also, everything with options, because it's 100 shares, it's times 100. So that coupon would cost me $1,700 right now. But It's giving me the opportunity to buy Disney in January for $185 a share or 18,500. And that's where, so these coupons hold value, and the value of the coupons also fluctuate with the stock price. And we'll get into that. But the main things that, that I think you really want to understand when you're buying an options contract is one, the expiration date, right? And I'll show you an example of the options chain in a second. And every options chain looks a little bit different depending on who your broker is, but at the end of the day, they all kind of give you the same information. So what do we need to kind of know? The main important things. Expiration date, because that's when your contract is up, right? And then the strike price, which is what you want to buy the contract, what you want to buy those shares for. So like in this example, I was saying Disney at $185. So I would go find the $185 strike price. That's what that means. Then there's your premium, which is what you're going to pay for that coupon. Okay, and then you also want to remember that it's times 100. Okay, so let me pull this up. Now that we kind of said that, let me pull up this options chain of Disney. So here we go. This is Thinkorswim, which was TD Ameritrade software. Like I said, everything looks a little different. But when you look at an options chain, you're looking at a couple different things. One, so with Disney, these are all the different expiration dates. Okay, so in the example I just gave, I said January, which end of the year. So let's look there. Okay, so now I opened up my chain. As I scroll down, right here is all the different strike prices. The strike price is what that coupon allows you to buy it for, right? So I wanted to be able to buy Disney in my example at $185 a share. So there's my $185 strike price. That's what we're looking at, right? And then how much is the coupon going to cost me? How much am I paying for that contract? Well, right now, the ask, which is what we're buying for, is $17.15. Okay, and so usually the way this works is the ask price, the premium that you're going to pay is kind of an indicator of where the market feels like this price is going to be. So because right now the $185, you're paying $17.15. You kind of group those together. The market is basically saying that at that date, this stock should be worth 185 plus 17, which is what, about $202. So, but my theory was, oh, I think Disney's going to be worth 250. So if Disney was worth 250, then yeah, it'd be way worth it, right? Now, if Disney was worth way less, then obviously this would be a bad trade or a bad bet. But anyways, so we got the strike, 185. We have our expiration. Okay, so we know when this expires, and then also we know what our premium is. That's always going to be the ask. Okay, so you're always going to pay the ask or something in between the bid and the ask. So if I went to go buy this right now, it says $17.50, but a lot of times when you go to actually place the order, your broker, depending on who your broker is, should try to give you the best fill possible, and you might be able to get something in between here, like maybe you get filled at $17 for the contract, or $16.95 or somewhere in those lines. But anyways, so everything that's on this side of the options chain is puts. Right now we're talking about calls. Calls are basically a bullish sentiment. So if I'm buying a call, that means I'm thinking the price is going to go up. If you're going to buy puts, that means you think the price is going to go down. And I'm not going to touch on puts right now for the purpose of this video, and so we can get through it in a timely manner. I'm going to try to stick directly to calls. Okay, so when I'm buying a calls contract, basically I have two things. There's two approaches for this. One is I can hold to expiration and exercise it, which is what I gave you in the example, right? So that means when January rolls around, I'm going to evaluate where the price of Disney is right now. And if it's worth $300 a share, oh yeah, I'm going to exercise. Exercise means I'm going to go ahead and buy those 100 contracts. So that's one way you can approach this. The other way is to just trade contracts, which usually is what most people do. That's what I usually do. Is I'm not looking to exercise. I'm just looking to buy this contract today for $17 and then down the road sell it for a profit to somebody else. Okay, but first off, if I wanted to hold the expiration, let's start there. So if I wanted to hold this to expiration, that means I have the intention of eventually buying these shares. So a couple things you got to know. If you're going to exercise, you need to have the capital in your account to purchase those shares. Okay, so if you don't have 18,500 in your account, your broker usually on the day of expiration. So in this example, we were looking at January 21st, 2022. So on that Friday, when the option expires, depending on your broker and their risk department, when they do it, they'll go in there. If you don't have 18,500 in your account to exercise that option, they'll go in there and just sell the contract. If it's in the money, they'll go in and sell for you. If it's out of the money, meaning the price of Disney was below 185, they'll just let it expire for you. It doesn't matter. So if you have the capital, you got the money sitting in your account, you're ready to go. Typically what will happen is once the day ends, the market closes, you got the money sitting in your account, you got this contract that's in the money sitting in your account, your broker will go in and just do it for you. At least that's the way I use Charles Schwab and I use TD Ameritrade, and both of them, they'll just go in there and automatically exercise for me at the end of the day. The other thing that you need to realize is your premium is gone. So that $17 that I spent on that contract, the $1,700, that does not apply to buying the contract. It's not like, okay, I need 18,500 less 1,700. No, I'm buying these shares for 18,500. The 1,700 I paid is gone. So because of that, I kind of need to know what my break even is, right? So actually, and just to get into break evens, I'm going to pull up my Charles Schwab trader, because Charles Schwab shows the break evens a little bit easier. So let's see here. So this is Charles Schwab's Street Smart Edge software, and it's a little bit different. If I'm in Charles Schwab and I want to do an option, it works the same way. Here's my chain. I already have it pulled up, but I can actually pull up any day of expiration. But for right now, we're going to go with this January 21st, 2022 for Disney. Okay, there's my DIS. And if I want to buy, I need to click on the one I want, so the 185. I need to go up here and hit buy to open, because I'm buying a new contract, or I'm buying a call to open a new position. Okay, quantity 1. Right now it's saying a price limit of 1650, which is, see here on theirs, it shows the last trade was 17. The bid is 1650. The ask is 1715. The midpoint is 1683. So that probably wouldn't get filled. So I may need to change this limit price to something a little higher. Limit is what I'm willing to pay. I'll just put $17. But what it does give me here is my break even. So there's my break even right there is 202. Meaning if I take this all the way to expiration, I need it to be at least $202 to make sense, right? So because I'm going to pay $18,500 to exercise those shares, and I already put $1,700 out there, to buy that contract. So really, I needed to get to 202. And if we go down, let's say I pick the 220 contract. There we go. Buy to open. I'm getting 1. My limit price is 620. My new break even is 226.20. So $220 strike plus the $6 that I put in. So now in order for me to make money on this contract when I exercise it, for it to be a good trade, I need to now get to 226.20, which is basically the difference between the contract and the strike price. Okay, so that's like I said, the Charles Schwab one. I actually like that a little bit better for options trading. I love Thinkorswim. I use Thinkorswim for everything else, but I'm starting to really get a feel for this options layout that they have in the Street Smart Edge program, and I'm really starting to like it. Um, so that's basically what would happen if we wanted to hold the expiration. Okay, and we need to make sure that we're paying attention to what our break-even price is, because you know, if you're paying a big premium on that contract, that means you need the price to move even further past what the strike price is to make it worthwhile, right? So now trading. With trading, which is what I most likely, or I most commonly do, I rarely ever exercise. The only time I'll exercise is if I really like the stock and I'm trying to, kind of like that Disney example, where I'm going to buy it way out and then I'm going to see it and then maybe I'll buy it later. But for the most part, I'm usually just trading contracts. I'm buying it for a certain price, letting the price go up, and then selling that contract to another trader out there who wants to buy it. And I'm keeping the difference, right? So, what we need to understand with trading is what's referred to as the Greeks, okay, and how they affect the contract price. Now, I'm not going to get super heavy into the Greeks. There's videos out there that are hours long that'll really explain it, but you do need to have somewhat of an understanding for how they work. So I'm going to switch back over to our Thinkorswim app just so we can kind of see this. So again, basing on this Disney, we're looking at the Disney chain. We'll just stick with this. I'm going to switch this over now. So right now we were looking at the bid and the ask, right? But I'm going to change this over to give us the Greeks. Okay, so there's certain Greeks that we need to know. The first one is theta. All right, so theta is your time decay. Theta is every single day that goes by, your contract is going to lose value. So if I bought this contract for $17.15, tomorrow it's going to lose 3 cents value. So now it's going to go to $17.12. The next day it's going to go to $17.09. The next day, $17.06. And it's going to continue to lose 3 cents every single day. That's how your theta works. So, when you buy these contracts, especially in smaller expiration dates, like maybe a date that's only a week away or 2 weeks away, that data is going to be higher, and every single day your contract's going to lose value. So you're going to need some price movement to really make some money. Now, the second thing that you kind of need to be aware of is the IV. Okay, so the IV of a contract is basically, let's see here. So if I look at this options chain, every options chain has an IV. So right here, for Disney, IV is pretty low, right? So we're looking at roughly between 30 and 40%. Now, and let's just to give you an example of how that works. So let's look at the May 21st. So May 21st expiration, we're going to take a look at Disney, let's say right at the money. Okay, so Disney, if I wanted to get an at the money 187.50 call, I'm going to be paying $3.60 premium. Okay, so that contract's going to cost me $3.60. Not bad. Okay, that means in the next 2 weeks, I just need this stock to move, up to what, 190-ish, 191. Okay, well now, let's take a look at a similarly priced stock that is, much higher IV. So I'm going to go to GME, which is GameStop. IV is actually pretty low for GameStop right now, but remember, Disney was at 30%. GameStop is over here at, in the hundreds, 111% for this May 21st. Okay, so almost 3 times the IV, which is the applied volatility. So now let's look at the price difference. At the money, $10.15 to buy a contract at the money. So we're paying almost 3 times the amount to buy this GameStop contract. And the reason that it's so expensive is because the IV is higher. Okay, so the IV is 3 times as much. And what affects that is, and again, I'm not going to get too deep into the Greeks, but this Vega column. Okay, so Vega is directly correlated to the IV. So for every IV percentage, right now IV is 111% on GameStop. If it goes up to 112%, the contract price will go up 13 cents. If it goes up, let's say 10 percentage points to 121, this contract's going to cost $1.30 more, and so on. So if all of a sudden the IV on this doubles to 200%, we're probably looking at paying an extra $13 for this contract. So this contract would now cost us like $23 at the money. Okay. So you really want to pay attention, especially, I mean, anytime you're buying options, where this IV is. Okay. And again, it's in different places on different brokers, but in Thinkorswim, it's listed right here next to the chain. I usually don't want to buy options on anything more than 100%. Maybe 80 to 120 is kind of a good range, because I'm buying like more volatile stocks, and the IV is basically the implied volatility, right? So it's basically, what it's doing is implying how much movement the market thinks this stock is going to move. So with a stock like Disney, it's got a low IV because it doesn't move as much as a volatile stock like GameStop. And just to give you another example, let's look at some kind of other similarly priced stocks. So like Ford, for instance. Ford is right now trading at 1182. Let's go May 21st again. Again, 39% IV, implied volatility, right at the money, 22 cents a contract. That's pretty cheap, right? That means it's going to cost you $22. Now, let's look at and the reason why is this 22 cents and why is Disney $3? Well, it's also kind of correlated to the actual underlying stock price, right? So Ford is a $12 stock, so 22 cents is just a fraction of that. Then you go to Disney, is a $185 stock. You're going to pay a certain percentage of the stock price, so that's why it's higher. So higher the stock price, higher your premiums are going to be. Lower the stock, lower the premiums. But anyway, so Ford, 22 cents, okay, with a 30% IV, 40% IV. Well, let's go to one of the other ones that I know has been extremely high or higher that I've actually did a video on recently. Clove, same thing, at the money. IV is 132, so almost 4 times higher than Ford, and we're going to pay 70 cents, okay, for an at the money call. Now let's look somewhere in the same price range. Another stock that I know is priced around here that's got even higher IV, OCGN. IV is 261%, so we're talking huge, implied volatility at the money, $1.27. So you're paying when, now I feel like I've been almost going on too long, but the point I'm trying to make is, when you go to buy options, if the IV is through the roof and it's up there in the 200, 300s, all that, you're paying an extreme amount of money for that premium, right? And then so now that means you need the stock to move even more to actually be profitable. On top of that, if all of a sudden the IV drops, as we saw, like GameStop, I think it was 13 cents for every percentage point. So if GameStop keeps trading sideways and sideways, and that IV ends up dropping down to 30%, that's almost $1.30 for every 10% it drops. Every 10% it drops, you're going to lose $1.30 off that contract. So we were going to pay, I think, $10 for the contract. Every 10% the IV drops. Even if the stock price just stays the same, you're losing. Your contract's just going to lose money based off that IV. So something to pay attention to. We said theta, we said IV. The last one I want to show you is the delta. Okay, so let me pull this back up, and I'll just show you even on this OCGN. So right now, you know what? I didn't like OCGN. Let's go back to Clove, just because the IV is so high. So we'll go to Clove. Has kind of an IV that's in the range of what I normally trade. But so this Clove contract, let's say the $9 call, this delta column right here, I kind of look at as a probability indicator. Okay, so if the delta is 0.48, that means it's got like a 48% chance of ending up in the money. Look down here, let's say the $20 for May, it's only got a 5% chance of ending up at $20 by May 21st. At least that's the way the market is pricing this. Then you look up here, let's say the $5 strike, it's got a 100% chance of being at least $5 by the time the expiration rolls around. So I kind of look at those deltas as a probability indicator, but at the same time, just so you understand how options pricing works, what makes your option price go up? Basically, what happens is, so right now, if Clove is at $9, for every dollar it moves, so as Clove goes up from $9 to $10, it's going to add the delta plus this gamma, subtract the theta, and then that's where you get your next price. So if right now this $9 price is 70 cents, if we move up a dollar, we can expect to add on what, 67 cents minus 3, somewhere around 64 cents. So this contract would now all of a sudden be worth $1.30, somewhere around that, just if you wanted to. But really, at the end of the day, I just wanted to give you an opportunity to see what those things are. Really, what you need to know is, theta decreases the value. So theta is going to decay away. Every single day you hold on to that contract, theta is going to be whittling away at its worth. Okay, so every day you're losing a little bit of value with your theta. IV, you want to pay attention to, because IV is going to mean you're buying an overpriced contract if you're buying with these high IVs. Or if you can get in on a low IV and then the stock starts moving, maybe IV jumps, that can add on to, how much you can actually make. And then that last one, the delta, sometimes I'll look at that as a probability indicator. Okay, well, the market's kind of pricing this as this got a 30% chance of hitting this price by this date. But really, now that you kind of understand a little bit, hopefully, how this works, I'm going to show you this website that I typically will look at to figure out. And this is called Options Profit Calculator. And I'll throw the link down in the description. But for right now, we're just working long call. So when you get to this website, we're going to click on this long call. I'm going to scroll down. And let's just go back to Disney, since that's the one we've been talking about. So I'm going to type in my symbol, Disney. It'll auto-populate the stock price for me. I want to buy a call. So now I need to tell it what option I'm looking to buy. So I'm going to go select option. And this is a free service, which makes it really cool. And it helps you kind of gauge where your stock price will move on a daily basis. So we were talking about the January 21st, okay? And I believe we were looking at the 185 strike for $17. So I'm going to click my thing. There we go. So I got Disney. I know it's going to be, this is the stock price. I selected what option I wanted to buy. Now I'm going to come down here and calculate. So because we were gauging, I'm just going to put in here maybe $350 as my high range. It'll automatically fill the low for me. Calculate. And now we have this huge chart. So up here we see the days. Because there's such a wide range of days, it looks like it's just giving us kind of like random dates in between, which is fine. If you went with the smaller one, which I'll show you in a little bit, it'll give you every single day. So we know we paid $17 for our contract. So right now, this is showing, if you guys could see, that the contract, if the price is at 184, the contract will be worth about 16 bucks. So we probably, we lost, 5%. But what it's showing us here is how much we can expect this contract to go up. So by May 15th, which is, a week from now, if my contract, let's say all of a sudden Disney jumps to $200, my contract's going to be worth $25.94 or $2,500, $2,600, and I made a 51% gain. But what I want you to pay attention, because of theta, if it takes Disney until August, let's say August 4th, to get to 200, that contract's only going to be worth $2,300. Keep going. Let's say in October now, October 6th, Disney gets to 200. It's only going to be worth $20, right? So now I'm only up $3. All the way to December. Remember, we're expiring in January. So in December, contract's only going to be worth $17.13 if Disney's at $200. Okay, and at expiration, if Disney's at $200, contract's only worth $15. I actually lost $2.10. Okay, now I was using 200 as an example, but just so we can kind of see how to price these things out and how much money you can actually make on options. So we bought this contract for what, $17? If all of a sudden something happens in July and Disney jumps up to $248, this contract can go up to $64, right? You know, also they lose value fast if, you know, it falls below 180, contract really gets cheap, 30 cents, you know. So I use this to, for the most part, give me an idea of where I'm at. And this was a long-term contract we just looked at, you know, for all the way until the end of the year. If we want to get kind of a better explanation of what happens like on a daily, which is what I normally would trade, is like something that's a month out or 2 months out. I'm going to pull up Clove. Okay, so let's see here. Put this back on. So here we go. Let's go Clove. Okay. Right now it's trading for $8.60. May 21st is a day I'm actually looking at, and I have some options on. But let's say I buy this $11 call for 30 cents. Okay, so the contract only cost me 30 bucks. I'm going to price this out all the way up to, let's say, $15. Calculate. So now you can see every single day is listed up here. We have the 8th through expiration, which is the 21st. And we can kind of get an idea as every day passes. I bought this contract for 30 cents. It's worth 30 cents on the first day. But now on the very next day, it's going to drop down to 28 cents, then 25, then 22. So this contract is losing value. That's that theta decay going away. Every single day it's losing value. But what we're looking to do is, when I talk about trading, remember I bought the $11 call. I don't even need it to hit $11. If all of a sudden on Monday this contract jumps to 10 bucks, I just made 140%. I could sell that contract now and get out, make my money, and and move on to the next one. And that's what I'm talking about when you're trading options. You know, if you kind of understand how this works, you can pick a strike that you don't even think is attainable, but as long as you can hit that in the opening days, that's where you can make some money. So, you know, this Clove example, I bought these contracts at 30 cents. So let's say I bought 10 of them. So I spent 300 bucks. Okay, and now all of a sudden, it even takes a couple days. Maybe we're 4 days in, and it jumps to $10. Well, 60 cents. I doubled my money. So now my $300 turned into $600. I sell that contract to someone else. And the reason you want to get in and out is because these, you know, again, it's losing value every day. Remember, I bought the $11 call. So the more I hold this, all of a sudden I start losing money. You know, yeah, I could double my money if I sell it here for 60 cents, which is what, May 11th. But if I hold this contract into, you know, with the final week of expiration, we start holding this thing and the stock's only at $10 in this last week. Now I lost value. Now it went from being worth 30 cents to worth 60 cents when we hit $10 to now all of a sudden it's only worth 14 cents. Why? Because it's not in the money anymore. You know, and it's losing that value of speculation. Okay, so the way these things are priced and the way all of this is figured out is based on speculation. So why are you paying 30 cents for an $11 call when Clove is trading right now at $8.50? Well, that's that extrinsic value. That's you're paying that premium because, you know, if it does hit $11, that person that's going to give you those shares wants that incentive, that premium for it, right? And so that premium is going to bounce, as we just showed you with that website, as the as the stock goes up, and that premium is going to decrease as the stock goes down. So when you get into trading, you kind of want to get rid of, make your money, get out. Make your money, get out. A lot of times, what I'll do is if I think that a stock still has room to grow, I like to buy multiple contracts. So instead of just buying one contract, like I gave you in the Disney example, I'd rather do like I said in the Clove example, where I bought 10 for $300. Now, when the stock jumped to $10 and I doubled my money, maybe I'll just sell five. So I sell those five, get my 300 back, and now I still have five contracts rolling. Okay, and now I can see if we can get a little bit higher and make some more money. Because, as these things go, which you can see here, and the reason why options you can make so much money on them is we just talked about an example where I spent $300 on this 30-cent contract. But what if all of a sudden something happens with Clove, like we talked about, maybe being a gamma squeeze or something, and this thing really skyrockets up to, 13 bucks. But when it gets to 13 bucks, we're now looking at this contract being worth $2.24, $2, even if I held it to expiration, $2. So that's for every $30 I put down, I'm now making 200 back, so that's a 567% gain. Okay, and I mean that's huge. You can't make gains like that with stocks, right? If I bought my example, $300 worth of Clove, that's only going to get me trading at about 10, but let's just say trading at about 10 bucks. That'll get me 30 shares. So 30 shares of Clove, in order to make that kind of money, I need that stock price to almost, double, triple, quadruple the actual underlying stock price, where all of a sudden, we would need this stock to go up 567%. Whereas in this example, we just needed the stock to go up maybe 20% or 30%, 10% to make money off that volatility. And because the options contract gives me the movement of 100 shares as opposed to 30 shares or 20 shares or whatever you want to buy with that 300 bucks. I hope that makes sense. So, some common questions are basically max risk, it's what you pay. So in my Disney example, we bought the contract for $17, so my max risk is $1,700. I can't lose more than that. Whatever I paid for the premium is what I could lose. In my Clove example, we bought those contracts for 30 cents, $30 a piece. I bought 10 of them, so my max risk would be $300. No matter what happens to Clove, if they tank and go bankrupt, I could still only lose that $300 that I put in. Okay, now how much can I make with options is almost unlimited because of all the factors we discussed, right? So as the stock goes up, we're going to continue to see, all the theta and the gamma and everything increase, and we can start making, 500% gains, 1,000% gains. And when that's happening, other people start buying options in it, and that starts getting the IV to increase. And so now your Vega multipliers start adding on, where all of a sudden, these things, you could get some huge gains in options. It doesn't happen all the time. And options are risky because you can lose it all. You can't. Whereas with stocks, if I own a stock and the stock goes down, 10%, I only lose 10%. If I have options and that stock goes down 10%, it's probably worthless. As you saw in that options profit calculator, it's going to fall below to a level to where, even that 30-cent one that I bought is only going to be worth 2 pennies now, or a penny or something along those lines. And it's just, so there's a lot of risk involved. Can you sell at any time? Yes. So you could, in terms of the option contract, when you hold that contract at any moment, I could sell the contract. It's easy, it's simple. I could just, dump it off. Now, volume takes a little bit of a play in that, because if it's a low volume stock, which typically I won't trade, but I have gotten stuck in some stocks before that I thought something was going to happen and it ended up being super low volume, and I tried to get rid of the contract and it took a little while to actually sell it. And you'll know a lot of times based on the bid and ask as well. And let me pull this up one more time. So when we look at this bid and ask here, usually it should be pretty tight. Like this is a 5 point spread. This is a five cent spread, you know. But if you're looking at an option where all of a sudden the spread between these two is, $2, $3 or something, that usually is going to indicate that it's a low volume one, and it's probably not a good idea to do it, because if you think about it, that means you're going to buy it for, you know, let's just say $3 a contract, but when you go to sell it, people are only willing to buy it for $1. So now you're automatically losing money on that. So wider spreads, I'll typically stay away from. Can you exercise at any time? That's another question that I've gotten a lot. And yes, you can. Typically, if my intention is to exercise, I'd rather wait until the end. Going back to the Disney example, yeah, I have the ability to buy this stock at any time with this coupon for $185 a share, which equates to 18,500. Okay. And yeah, I mean, it expired in January in the example we gave. And let's say in August, the stock's trading for $300. Yeah, you can go in right now and buy it for 18,500, but why? And, like, I would rather wait until January. If my true intention was to exercise, wait until January and see where the stock price is at then, because, what if the stock ended up falling below 185? At that point, I don't want the shares anymore. But I can see there are some reasons why. Let's say you only have one contract and you want to take half that profit. So, yeah, in that example with August, let's say it's trading at $300, and so now, those shares are worth 30 grand. Then yeah, 18,500. Throw it down, get your 100 shares. Those 100 shares are worth 3 grand or 30 grand. So now maybe I can sell half, sell 50 shares, get my 15,000 back, put it in my pocket, and now I still have 50 shares riding. So that would make sense. Or if you're expecting big news after hours, then you might want to exercise beforehand, because you don't have the ability to do anything with your options contracts once the market's closed. So from 6:30 a.m. to 1:30 p.m., or I'm sorry, 1 p.m., which is the trading hours here on the West Coast, that's the only time you can do anything with your options contract. But if you exercise them ahead of time and now you have those 100 shares, well, now you still have the ability to trade in after hours up until 5 o'clock at night, and then you can get back up at 4:30 in the morning or 4 in the morning and still do something with those shares. So I can see where there can be a time where you would want to exercise, but for the most part, I usually would wait until expiration to see if that price dipped back down and I didn't want the shares anymore. Also, the exercise at any time, you have the ability to, but it depends on your broker on how that's done. So with TD Ameritrade, I have a button on my app I can click that says exercise, and it'll do it. As long as I have the money in my account, it'll do it automatically. With Charles Schwab, typically it'll just exercise them for me at expiration. If I want to exercise early, I actually have to get on the phone and call them and say, hey, I have this contract in my account. The money's in my account. Can you go in there and exercise it for me? Takes a little bit longer to do that early exercise, but it can be done. Placing an order, I kind of already showed you on Street Smart Edge, and that with the whole buy to open and making sure that you have everything set. In terms of, and I'll show this real quick with Thinkorswim. When you want to buy an order in Thinkorswim, basically what you do is you click on the ask, and I know that there's some other brokers that are like this too. So if I'm looking at, here we go at Clove. If I go over here and click on the ask, let's say this 30-cent one that we were talking about, all of a sudden this order comes up. Same type of stuff, single order, I want to buy, +1, I want to buy one contract. If I wanted to buy more, I could always, change that value. And it's expiration, May 21st, $11 strike. It's a call. Price is 30 cents, limit. So all my same information's here. It's just the way that your broker lays it out, right? And different broker platforms are going to do it in different ways. Make sure everything's correct. Hit confirm and send. Always remember that it's times 100. So if it's 30 cents times 100, $30, right? And then if I wanted to buy 10, like we had talked about, well, there's 13 there, but if I wanted to buy 10, like we talked about, I put 10, and now that's going to be $300, right? So $30 per contract times 10 is going to cost me 300. Hit confirm and send, it'll send it through. Okay, and really every broker is different on how you're going to. But when you want to go to sell it, like with my TD Ameritrade ones, when it's time and I'm trading, I can go in there and on my order list hit close, and it'll give me an opportunity to sell it on Street Smart Edge, which we were looking at as well. So remember when we wanted to buy it, I went buy to open. Okay, so I'm buying a contract to open a new position. So when I want to get rid of it, I'm going to go sell to close. I'm selling that contract now to close my position. So buy to open, sell to close. And I know from talking to some of my friends that a lot of different brokers use that buy to open, sell to close method because people who want to write contracts are using those other ones. We'll talk about that on a different video if you guys enjoyed this one. Okay, so in terms of IV, when I should buy shares, when I should buy contracts, for me, a good rule of thumb is when IV is low, it's a good time to buy options. All right. You know, put a bet down. You got low IV, it's a good time to do it. Shares, I want to get into when IV is high. So we looked at some of those examples, like I think OCGN, the IV was at 260. I mean, that's way too expensive to go in and buy a contract at. So if I really liked that stock and I wanted to get in on that stock, I'd just buy the shares, right? Or if I'm long term on a stock, I really believe in this stock's future and I want to own it for a long time, then what I would end up doing is I would go in and buy, either a long term contract like we talked about with Disney, where I'm going to price it out for the end of the year, or I'll just buy shares because at the end of the day, with options, the biggest risk involved is the expiration date, right? So I really like this stock, and I believe in its future. But now I bought the August expiration date, and the stock didn't hit that point by then, so I basically, pissed my money away. And then the stock takes off after that. Yeah, I was right that stock was going to do great, down the road and had this great future, but it didn't happen in time for my options to make me any money. So that's why if I'm really like solid on a certain stock and I want to own this for the rest of the rest of my life or whatever, it's a long term play, I'll just buy the shares. Another question: in the money or out of the money? And you'll see those a lot. So a lot of times, some people even label on option chains. You have ITM, which stands for in the money. ATM, which stands for around the money, which is those strike prices that are a little bit in and a little bit out. And then OTM, which stands for out of the money. Which ones do I buy? Really, I would say play around on that options profit calculator and do what you think makes the most sense. But one thing to remember is when you buy in the money, you get that dollar for dollar movement for the most part. So if I buy, Disney's trading at 185, if I was to buy a 140 strike price on Disney, every dollar movement that Disney has moving forward, I'm going to gain $100, because I'm controlling 100 shares per contract. Now, with out of the money ones, now you're more looking to trade or you're making a bet, but you're able to buy a lot more, kind of like that Clove example. You buy out of the money. I bought a price that I don't even think it's necessarily going to hit, but it's cheap at 30 cents. Now I'm trying to play that movement. So now the stock goes up, my 30 cents turns into 60 cents. I doubled up, I could get out, or I could stay in and maybe let it get to $1 or $2. So really, it depends on what your goals or your objectives are. If I have the intention of exercising, I'll usually buy in the money or right at the money, knowing that, okay, now this stock's going to move forward. I'm going to get some gain with it, and I'll be in the money when it's time to exercise. If I'm looking to trade, I usually will go out of the money. And it really depends on how far out I go. You got to be realistic. how many stocks are going to move 10%, 20%. So, maybe, in a 1 month time frame or a 2 month time frame. And sometimes I'll kind of keep that in mind too. If I'm going super deep out of the money, then I'm looking, okay, this stock is supposed to have news coming up and a catalyst coming up this month. So I'm going to buy it super deep out of the money and closer to that catalyst date. And then as soon as the catalyst takes off, I need to get out of this within the next 2 days. Otherwise it's going to keep losing that value. I hope that makes sense. Why would you buy options? I think I kind of, touched on that. One is to, play off volatility and trade volatility. And as a stock price moves up, make more gains than I would with shares and sell and get out and trade. But the other reason, kind of the reason they were, made, I think, is to use less capital now to buy shares later, like my Disney example. That's a long video already. I'm looking at the time. It's 50 minutes. That's a lot longer than what I expected. I hope it was informative. If it was, leave me some comments. Let me know what maybe I didn't touch on or what you want to hear more about. Or, also subscribe, because if you do like the video and you ask more questions, I want to go over puts. I want to go over some more strategies that aren't as risky but don't make as much money that you could do with your shares. There's a lot more stuff you could do with options besides just buying calls. But I wanted to make this video about buying calls because I feel like at the end of the day, that's what a lot of newer traders are getting into. And that's how you can make the most money. I mean, in terms of big money, right? You can also lose everything. It's very risky, but buying calls or puts, which we can go over later, that's where you're going to make your biggest gains. That's where you can come and walk away with 300% gains, 1,000% gains. But that's why it's risky as well. So anyways, if you like the video, subscribe, because I'll drop some other ones, but also make sure you like it and leave me a comment. That way, and especially questions, I'll try to answer them, or I could even put it in another video and make sure I touch on that in the next video. All right? I'll see you guys in the next one.